I'm Tom Selzer from Livewire Markets, and joining me today is Justin Muzinich, CEO of Muzinich & Co. and former Deputy Secretary of the Treasury, to offer his expert insights on US monetary policy and private credit markets. Justin, thanks for joining us.
Thanks for having me. It's great to be here. Great to be back in Sydney.
Justin, I'm going to start with US monetary policy. What do you think are the biggest fundamental questions facing the Fed right now?
I think the Fed is trying to figure out a number of difficult questions. Inflation remains fairly sticky. If you looked at the numbers from last week, markets, I think, were happy that core inflation came in slightly below expectations. This is typical of Wall Street. They came in at 2.9% instead of 3%. And everyone thought all these rate cuts were imminent. But 2.9% inflation is still quite high. So I think inflation remains sticky. And that's especially challenging for the Fed because we have growth, but the job market is also not as strong as you'd expect given the growth. And what's interesting to think about is, how much of that weak job growth is due to AI? And are we in the middle of a growth cycle where jobs won't follow in the same way they have historically because AI is leading to more efficiency? You had Amazon just a few days ago announce quite a large reduction in its workforce, partly because of AI. And so these dynamics of inflation being sticky and sort of jobs not being that strong, I think puts the Fed in a difficult position.
Maybe on that jobs point, how do you think the current administration, I think they've said this is their goal, is to reshore industry to the US. How do you think they can balance that with also maintaining the US dollar's role in the global economy?
They're trying to achieve a number of things through, sort of tariff policy, which is sort of, what they've. I think the mechanism they're using to reshore. I think a large part of it is what we call in the US sort of economic security, that is not being dependent on countries you don't trust. Sort of in your own supply chain. So, I think one way to maintain the dollar's role in the world, while also being sensitive to economic security, is really differentiate between national security related industries. For instance, anything related to defense, AI, quantum, those sorts of things you reshore, or you work very closely with close allies like Australia and the critical minerals deal that was just signed. And in other industries, you still allow a robust trade and have the dollar be at the center of commerce. So I think that's the way to balance it. And my sense is that's the way it's heading. If you look at President Trump's trip over to APAC just this week, he is quite interested in engaging in commerce. For instance, with China, he made a comment that we want to make sure China is buying American soybeans. That's not a national security industry. And despite that, I think in these national security related industries, you will see a continued pulling apart of the economies.
We're going to move to private credit markets now. What do you think the current outlook is there for the asset class? How is it evolving, and maybe what's the sell there for investors?
Private credit has a number of really terrific traits, but it's also the asset class has evolved a lot over the years. And in certain parts of private credit, I think there's too much capital. So just to start with what's fundamentally appealing about it is you earn an illiquidity premium. And that illiquidity premium has historically only been available really to institutional investors. And more that's being made accessible to non-institutional investors. There's also, you don't have this mark-to-market volatility, I think, which is really, really appealing. If you invest in public credit, you don't sleep as well at night because every day markets go up and down. Whereas in private credit, all that matters is your credit work. Is a company going to pay you back when your loan is due? And as long as it's going to pay you back, you don't have all this noise along the way. So I think that's also an inherently sort of good feature of the asset class. But what has happened, we've been in the private credit business for 10 years and in credit for now over 30 years. And really what we've seen happen is there's just been so much money raised to invest in certain parts of the private credit market that returns aren't what they used to be. They've come down a little bit, and you really have to be much more discriminating and much more risk sensitive and not just following the crowd.
I think now Muzinich & Co. is operating in 17 countries, including Australia. What do you think is fueling that expansion, and where are you seeing those growth opportunities?
what's resonating with investors about the firm, really two things. The first is that we're credit specialists, and the firm was founded 30 years ago, and I get approached at least once a quarter by someone who wants to join to do equities or commodities or some other asset class. And we've always said no. And you can understand the business reason for wanting to diversify. But the reason we say no is you can't be good at everything. And we feel that by specializing, we just give ourselves the best shot of delivering value to investors. And our investors like knowing that we will only eat well if we do credit well. We can't have a bad year in credit and say, oh, it doesn't matter, our equities book will do well or our commodities book will do well. So there's an alignment. And I think in a world where people trust Wall Street and trust finance less and less, they really like that alignment. I think people also really like that we're private. We've stayed private. We have no private equity firm owns us. We're a totally independent firm. And there are fewer and fewer dedicated firms in credit that are private, and people sort of like that. The ability to just maintain a long-term view, not have to think about quarters or playing silly games that Wall Street plays.
Maybe dive in a bit deeper into that. How would you say your strategy differs to others in terms of outcomes for investors? How are you going about achieving those outcomes?
The firm is fundamentally based on deep credit research and thinking about achieving good risk-adjusted returns, not just returns. It's very easy in credit to say, I'm going to buy the thing with the highest yield and just try to, over a short period of time, earn the highest return. And often, investment firms will try to win business that way, but just by posting a high yield and saying, invest with us because we're earning 1% more than the market. But over a cycle, that often ends up being a bad decision. Because you're not sensitive to risk. So, our business for 30 years has been based on doing fundamental credit analysis to understand risk first, and then making investment decisions. And that's served us very well, over 30 years.
Do you mind explaining maybe a bit more about parallel lending and how it maybe differs to other private credit strategies and what your approach is around parallel lending?
It goes back a bit to what I said earlier. The traditional parts of private credit, what people call sort of upper mid-market private credit, that business was traditionally financing basically large private equity deals. And it was a great business, for many, many years. But what happened, as is typical on Wall Street, something is attractive. Huge amounts of capital were raised for that business. And returns have come down. Lending documents are written less tightly. There are fewer covenants, fewer protections, for investors. And so what we've really done is to take a different approach. And we started this now 6 years ago, where rather than partnering with private equity firms to finance their deals, we partner with banks to source lending opportunities from them. So we have a fund which is focused on parallel lending in Europe, where we have partnerships with 56 European banks. And these banks will show us investment opportunities. We take about 15% of what they show us. And what we really like about it is that it's lower risk. The loans we're investing in have about 50 to 60% of the leverage that traditional private credit has. So we think the risk-adjusted returns are much better by partnering with banks rather than by partnering with private equity firms.
And where else are you seeing the growth opportunities in credit right now?
In the public markets, we see good opportunities in the shorter duration part of credit. In a lot of credit, spreads are pretty tight, which just means things are expensive. In the shorter duration part of the market, you have better buying opportunities. And we also think we're in the later stages of the credit cycle. And you want to be careful, I think, investing in any asset class, sort of in this part of the credit cycle. And in the short duration part of the market, if there is a correction, you recover very quickly. It's a sort of more conservative way to invest, and there's good value there compared to other parts of credit. So we like that.
And finally, Muzinich & Co. was founded, I think, in 1988. How's the journey been over that time?
Sure, it's been terrific. I mean, we're very fortunate to have built a meaningful business. We've tried to remain very dynamic and bring creative investment opportunities and different investment opportunities to our investors. But I'd say the basic values of the firm haven't changed. We've remained focused on credit. We've remained private. And above all, we remember that this is not our money. This is our investors' money. We feel a great sense of responsibility because of that. And we try to maintain a humility, sort of because it is other people's money that they've worked very hard for, and feel a real fiduciary duty to try to deliver for them.
Justin, thanks for joining us.
Thank you for having me.
Thanks for watching. For more great videos, make sure to check out our YouTube channel.